Okay, folks. So, thank you for joining this class. We'll be talking about volatility. When I think it was Mode, when FX Street told me about this one day one topic thing, and they told me that the topic was volatility, I started asking myself, is it really something that I'd like to do? And then I realized that perhaps many of the people that would talk about it would be discussing VIX or would be discussing options. So I thought, why not? Let's talk about volatility and let's put a spin that would be specific for the spot market, since many of us are more into spot trading. So our exact topic: daily cycles, volatility, and trading the spot market. Now, before we get started with that, let's ask first, why is it an important issue? Why is volatility an issue for us? Let me put it this way. Markets will be worth nothing if we don't have volatility. Okay? It is from volatility that traders can take advantage of the market. Now, when you talk about volatility, you also have to talk about one other issue or one other item hand in hand. I always look at volatility as a function of volume. Okay? In instances where markets are thin and someone comes in with a good-sized volume, you move the market. In instances where volume starts to build up, you move the market. So volume and volatility goes hand in hand. But let's talk about how I view this topic. I tend to look at volatility, or I tend to classify market volatility into two types. One that is event-driven and another that is cyclical. Okay? When we talk about event-driven volatility, I talk about a spike that is due to a surprise, a sudden release, a sudden data, a sudden news event that maybe caught people off guard. Okay, event-driven volatility could also be the release of an economic data. The most popular of these, of course, is your non-farm payrolls in the U.S. And lately, we've been seeing changes in interest rates. So, event-driven volatility basically relies on a new variable entering the market. We end up with price action in an event-driven volatility because this new variable, this new data, this new information has an impact in moving our supply and demand lines. I'm sorry, but I seem to have lost my PowerPoint for this. But basically, the way I view the market, the way I view price action, always revolves on your ASAD model, or the absolute supply and aggregate supply and aggregate demand line. So, event-driven volatility causes sudden shifts in the supply line. If news is good, everybody becomes greedy. And if everybody becomes greedy, there's an increase in demand for financial assets. If news is bad and people become fearful, they start dumping financial assets, and you start seeing across the board sell-off. Now, how do you profit from this? We've had I would guess that we've had a lot of speakers already, and some of them probably would have touched on your plain vanilla options, your binary options, and that's one of the primary ways that people can try to take advantage of volatility by trading options. Plain vanilla basically means that you either have a call option or a put option that becomes in the money because your event basically moved prices through your strike. Okay? Or you could use a binary option. But let's talk about how I would try to take advantage of event-driven volatility in the spot market. I think some of you guys have seen me do this. For me, I try to just use a very simple method. I use a straddle. Okay. Some of you folks have seen me do this. Again, I use a straddle when I try to capture the potential price action that follows a release. So let me just show you how I normally would do it. Say we've got data coming out of Australia. I tend to like event-driven volatility, or to trade events that happen during the Asian session. They tend to be more textbook. I don't have to stress myself out in understanding what market response should be. If the numbers are good during the Asian session, good data means good news for the local currency. Bad data means bad stuff happening for the local currency. It's that plain and simple. During the New York session, there's so many conflicting interests that you don't get a consistent response all the time. But anyway, let me just show you what I mean by doing a straddle when an event is coming out. So, what's a straddle, by the way? When you say that you want to do a straddle, you're basically putting a buy and a sell at the same time in the same currency pair or in the same financial instrument. So, if I were expecting trade balance data from Australia, and I'm not an economist. I like to read about economics. I like to study economic materials, but I don't spend my time predicting just what the trade balance of Australia is going to be. So instead of me stressing myself out trying to figure out what the number is going to be, what I would do is put a straddle. As we've said, a straddle is basically having a buy and sell at the same time. Now, I'm not saying go open a buy trade and open a sell trade. What I do is put a buy stop and a sell stop, and expect that when your new variable comes in, when the data comes in, and there's a significant discrepancy between what everyone was expecting, between what the consensus forecast was, and your data, your actual result, then you end up with some form of breakout. Okay, either data is good, your trade balance for Australia came out strongly, so you have a quick spike up, or data turns out to be poor, and you end up with a sell-off. The point is, when you trade with volatility, when you trade event-driven volatility, typically these are trades that you can go in and out of in a short span of time. Of course, some would want to hold on and try to maximize the move. But if you're someone who's just looking to get something out of the market, get a couple of pips on a sudden movement, then event-driven volatility trading might be for you. Personally, I don't really put my buy stop and sell stops manually. I use an EA that I have to do that. So basically, if I'm expecting news, I put my EA. I set up an offset on how many pips from the spot rate, from the bid, and how many pips from the ask would my buy stop and sell stop be placed. And if one of them gets triggered, okay, let me set a wide pip offset here. I'll just show it to you. Let me use 15 pips. Oh, sorry, I forgot to turn on. Let me do that again. And on. 150 pips. And if you look at my chart, you're going to see that we've got an arrow where a buy stop has been placed, the sell stop has been placed, and once data gets released and there's a big difference between actual and consensus, I would expect a breakout. And the other side of my setup will be removed. Okay? So, that's your basically that's the way your straddle trade works. You just wait for the breakout to happen, and if you're doing this manually, once a break happens, you remove the other side or the other trade. Now, folks, when you trade event-driven volatility, it is important to determine whether the news... Yeah, Don, exactly. This is an OCO. If one is executed, the other gets cancelled. Arnold, it's not a hedge, because in a hedge, you are theoretically already open. You're already in the market. What you do is put a buy stop and a sell stop. I don't see the point of entering the market at the same time market buy and market sell. Why take a loss on one side of the trade? Just wait for which would break out. The important thing is you're able to do this fast. That's why I use an EA for placing the orders. So it probably takes me about 3 to 5 seconds from between deciding I want to take the trade and having it done. Because if you have to plot it manually, it might take a couple of seconds. And the key thing is you want to jump in as late as possible. Well, and that's the risk of using a buy stop and a sell stop and having an event. There are times when the fill price is bad. But let me put it this way. These days, most of the banks employ algos to determine where the next price level is. So if you end up with, say, a very bad data or a very good data, you have your jump, your gap in prices, and typically you're just going to see a follow-through for a bit. Another observation that I have here is I actually have what I call the 1-minute rule when doing event-driven volatility. 1-minute rule basically states that if you have a trade opened or a buy stop or sell stop triggered because of volatility, if the number isn't so impressive, there's a chance of a 50 fib pullback happening, and that 50 fib pullback would happen within a minute of that release. And if you get past that minute, there's a chance that over the next 5 minutes another pullback happens. And once you're through with that next 5 minutes, then I'd say that, okay, market already has a clear opinion on where it wants to go. So it's something that I also would try to factor in. Is the data good enough, bad enough that it would sustain the initial? Probably sometimes you're going to see a gap. But the thing is, because the pricing model that's used by the banks are similar, you're not going to, okay, for those of you who've been trading for, say, 10 years, I think you remember a time when data gets released, and then after your gap in response to data, all of a sudden the next price quote will be right where the last price quote before the data was. That doesn't really happen that much anymore. In fact, I don't recall that happening. Even in the 1-minute rule that I have, typically you see a bit of a follow-through if the numbers are really far off that market had to gap in the next price quote. If the numbers are in line with consensus forecast, the smart thing to do is just get out of the market at that time. No point in holding when you cannot really sustain price action when the numbers were not that bad, were not that impressive. If the number was consensus forecast, remove your OCO, remove your straddle, because that's just going to create whipsaws more often than not. So that's how I would trade news. Now you might be saying, so what the heck does that have to do with our topic, volatility? Well, essentially the introduction of new data is what moves the market, is what created that spike in the first place. And normally what happens is a lot of people are just waiting on the sidelines. So data gets released, everyone reacts, volume picks up, and when volume picks up, especially if the numbers are far from consensus, that you ought to be able to get something out of the market. Just don't be too ambitious. The days when you have data coming out and all of a sudden you're 100 tips away from the market, I think that's almost over. I don't remember something happening like that over the last 3 years. Typically, there's a series of price quotes before you get your 100 pips, if at all you get there. But yeah, the older traders remember this. NFP comes out, and all of a sudden, the next price is 100 pips away. That doesn't really happen these days anymore. Okay, so that's how, or that's one of our types of volatility trades, event-driven. What about the more bread and butter type? Okay, so the other type of volatility trade that the way I classify it, okay, this is not something that the textbook says you have to classify that way. I just classify it that way because it's my thing. That's how I look at it. The other type of volatility is what I call cyclical volatility. So, remember, our title for the topic is Daily Cycles, Volatility, and Trading the Spot Market. So what do we mean when we say cyclical volatility? When I say cyclical volatility, what I mean is, over the course of a trading day, I'm sure anyone who's monitored the market has seen this. You will see specific time periods when you will likely get a spike, a breakout in your intraday price action. Now, this cyclical volatility for me is a result of two things. It's the result of your natural human daily life cycle, and it's also a result of geography. So what do we mean by natural human daily life cycle? Let's put it this way. People, MRC, yeah, we'll be showing it. I just don't have, I was about to get there, Jack. I'll show you the chart for that, but I won't show you the actual algo. It's a trade secret. Someone has to just figure it out from the way I monitor it. Okay, so where were we? What do you mean by human cycle? Well, people are biological beings. We cannot trade 24 hours a day. Some people I know say that they're trading 20 hours a day. I don't know if it's true, but there's been a lot of physiological study that says people who have been making decisions throughout the trading day, after 5 hours of making decisions, tend to make bad decisions afterwards. So the way I look at it, any trader with results, any trader who's good, probably takes his bigger trades when his mind is fresh, when he hasn't spent the trading day making decisions to buy or sell. Because the longer, physiologically, the longer that you've been trading that day, the worse your decisions become. Okay, it's something that has been not debated, but has been published as from scientific studies. Okay, on fatigue, on mental fatigue. Okay, so why am I saying this? Because basically, if that were the case, then traders who survive, traders who've been around, traders who do well, probably make the decisions when they're the freshest, or make the bigger trades when they are thinking more clearly, when they're thinking even better. So that means what to us? That means that these bigger trades, these more aggressive trades, are probably taken right when their markets open. So let's put in geography there. Remember, guys, that the currency markets are located all over. There's no central clearing place for the currency market, and currency traders are spread all over. Sure, London accounts for 1/3 of the market, but you also have other dealing centers or other trading centers, which means what to us? Which means that throughout the trading day, there will be times when volume spikes up. And during that time, when volume spikes up, any breakout that you get can basically be expected to continue for a little while, if not establish what's likely to be the trend for the day. So this is why Mondays, you typically see a gap in the opening of prices when Wellington opens. This is why when you have the Tokyo session, after a very quiet period waiting for something to happen, the moment Tokyo opens, sometimes you suddenly get a spike. And this is why, this is really the time that I like. People tend to think that the European market opens when London opens. But for me, the European market actually starts when, guess which country, folks? The European market actually starts when when Russia opens. A lot of aggressive traders out of Russia. And of course, you've got your London market and your New York market. But let me show you something. So, how do we... Russian market opens about 0600 GMT. Hey Chuck, is it 5? Okay, well, I have my setting at 0600. 5 p.m. Eastern. Okay, I'm not really sure what that would be in GMT times. Alright. I'm not really sure what that would be in GMT. But in my case, from my studies, from my observation, typically the move by the Russian market, the Russian breakout, would be about 0600. So how do I propose that we trade based on this idea that people are more likely to trade bigger sizes, more likely to be more aggressive, more likely to be right in what they're doing? So basically, once a market is opening, you might want to look at potential breakouts. All right, now, so how do I do this? If you look at my chart, oh, thanks, Jack. So, if you look at my chart, you're going to see that I've got 3 lines. Okay, the yellow line basically represents the open of the Tokyo market. Now, for me, if you want to trade the increase in volume from Asia, normally that means Tokyo, although in reality, the Asian market, or at least the Hong Kong and Singapore markets, are pretty close in size to the Tokyo market, which is supposed to be the 3rd biggest FX market. But from what I've seen in actual practice, breakouts during the Asian session that happen during the open of the Tokyo market are the ones that tend to be durable. So anyway, as a rule, following this human cycle thing, you expect that with the open of Tokyo, and then about an hour and a half after that, the open of Hong Kong, an hour after Tokyo, you have Singapore opening. You expect that during that time frame, during that period, breakouts, if they happen, will be able to sustain themselves. Okay? Normally, I give this a 1 hour window only. Open of Tokyo, and then give it an hour. If after an hour I don't get my breakout from Asia, then I'd say, hey, nothing happening. Let's remove those buy stops and sell stops, looking for where the breakout's going to be. And then you could probably, if you're doing this manually, then you could probably go out and have fun and then come back once 6 GMT kicks in. At 6 GMT, like we said, you've got your Russian market opening at that time. And normally, okay, in the chart that you see that I'm sharing with you guys, that 6 GMT breakout is defined by Pan. As a rule, I don't. VZ, it really depends on if I can figure out what is moving the market. But normally, if it's a Tokyo breakout, I'd limit myself to 20 pips at most. At most, I'd limit myself to 20 unless you're able to identify some other factor, some other news. That's why in my chart, I have it as yellow, because it's not a priority thing. I actually view it as something that you can just ignore. It's not a priority to join the breakout during the Asian session, not unless you know of data that was also released at that time. What is a priority for me is this window between Russian Open and before midday break in Europe. Okay, so normally I look at the window from 0600 to 10 GMT as a time where actually much of the trend gets established. Now, it's not a perfect system. If you're going to look at our chart, there were times when DZ, this is really part of the EA that I have. But I can make one for you guys. Give me the weekend and I will make just an indicator for this. And then you can visit my blog. And I'll put it in the free section. In fact, if you go to my blog, don't buy anything. That's for show. I don't really sell anything. Things are for free there. Okay, anyway. The idea is you've got much of the market opening. You've got Russia opening, you've got aggressive people from Russia, and then the bulk of liquidity in the markets. London opening about 2 hours after Russia. So during that period in time, I tend to expect that if there is a trend at all in the market, then that trend will be established during that time frame. So I like looking for the bigger move around this time. Normally the strategy for me would be get yourself 25 pips from the open of Russia, and once you have your initial 25 pips, try to use a trail stop. Try to see whether your London market will generate a follow-through rally or a follow-through sell-off. So the next window, in fact not the next, but the more important window in looking for a breakout is from that 0600 to 10 GMT. As we said, Russia's opening, Frankfurt's opening, and then of course you have London opening, when much of our liquidity kicks in. Now, you might say that, well, if that's the case, why don't we aggressively trade going into the New York session? The blue line represents the open of New York. For me, although New York represents a time, or the blue line represents a time when a market is opening, it also represents a time when a whipsaw, a pullback could potentially happen. You go back to your daily cycle. Your European traders cannot stay for 20 hours monitoring, stay in their desk for 20 hours. They have a life out of the trading room. So these guys might want to close out their trades. Okay, your European traders might want to close out their trades as the US market opens. So trading breakouts during the New York session is very tricky. It is prone to false breakouts. You're prone to pullback. So for me, what I do is ask myself, did we have a good trend in the European market? Did we see your average daily range from Europe? Did we see your average daily range from Asia? And if you saw a big move already from Asia, a big move already during the European session, then there's a big risk that with the open of the New York market, instead of you getting a nice breakout trade, or you end up with a pullback instead. So the only time when I would advise that a trade be taken on a breakout during the New York session is if market did not move at all in Asia, did not move at all in Europe, and that you are well within the average daily range. Excuse me. Because if you've had plenty of price action before the open of New York, there's a tendency for people to book profits, close their trades, and as they close their trades, you might end up with a false breakout. You might end up with a pullback. Alright, now we've talked about when are we supposed to jump in and take a breakout. When are we supposed to do partial profits? And when are we supposed to expect a more sustained breakout? The next question for me is, where exactly do you place your support or resistance lines? If you're doing it manually, it would be best, of course, to figure out where your strong support, strong resistances are, and use a break of those levels as your entry. Or you could figure out what was the congestion before the open of, say, Tokyo, and I will put my buy stop and sell stop at that range of the congestion before the Tokyo open, or the congestion before the open of the European market. Another way of doing it, and I will say it out loud now, will be to actually just use fractals for your potential entry points. Okay? Alright, so any other questions, guys? So basically, to me, volatility trading is all about either you're trading the news, and you're trying to take advantage of the gap, the difference between consensus forecast and the actual result. Or volatility trading could be about taking advantage of when volume picks up. Now, it's nice to trade the news. I am guilty of doing that many times, of putting an emphasis on what data is. But on a quiet day, when there's no market moving event, you are probably better off just waiting for the natural volatility to kick in. Your cyclical volatility to kick in. You're probably better off trading the open of the Russian market all the way to about just before midday in London. Midday trade, you don't want to do that. You don't want to take a breakout midday, especially if there's no data involved, because sometimes there's just a sudden imbalance in the market. All of a sudden someone did a big trade, but they're not likely to be sustained price action. Alright, so folks, any questions? Anything that you need me to clarify for you? Sure. Well, let me make some money out of the algo first. Once I made a small fortune, then I will share it for free. Let me make a fortune out of it first. Yeah, I know people are used to me giving stuff, and then somebody told me that, why are you doing that? Jack, basically the algo trades what you're seeing in my chart right now. It looks for that time on when to open a trade, and then well, actually you're seeing it. You're looking at it graphically. So the algo doesn't look for volatility, but it actually looks at the cycle. What time is it? Should I open my trade? Should I remove the buy stop and sell stop? What is the breakout level that I should be monitoring? That's what it does. Okay, so anything else, guys? This is 30 minutes. I know I'm actually used to trading the hourlies, but when I did this, I found that I can make more using 30 instead of the hourly. The EMAs are of course Fibonacci numbers. Cliff, actually, this is the first time that I did this. When FX instructor asked me to do it, and I thought of the topic and I liked it, and I have something to share, so I'm here. Yeah, me too. I like 21, especially in the dailies. 5 minutes. I don't trade at that level. That's too quick for me. Well, it might be worth looking into making an algo on. So guys, once more, thank you for joining this class, and I hope to see you next time I do something on one day, one topic. Thank you, folks.